Welcome back. This morning, the producer price index was reported 0.7% versus prior of 0.3. Just like yesterday's CPI, we see inflation rearing its ugly head. This also is related to surging energy prices. Core PPI, which excludes food and energy, is up zero point 0.4 versus a prior report of zero point 0.2. So we see this is an energy-led inflationary move, just like yesterday's report. PPI year over year, 1.6% versus zero point 0.8, literally double. Core PPI, excluding food and energy, actually down. Now, PPI here in yellow, this is year over year. It looks just like yesterday's chart, the consumer price index. The difference is producer price index. These are the prices that the producers pay on the wholesale level to buy these goods that they transform into consumer goods and services. It's thought that when producer prices go up, they'll pass those extra costs on to the consumer. Here, the yellow line, strong uptick related directly to energy, excluding food and energy actually not going up, actually continuing to move to the downside. Here's on a monthly basis, core PPI is in red, the standard number in white. And just like the CPI yesterday, we're registering the highest highs we've seen going back to mid 2022. This is over a 1 year high for the producer prices. Well, some may say, well, who cares? It's only energy. There's a lot of everything else that's going down. Well, the fact of the matter is we use energy for everything, not only for transportation, but to deliver all these other goods that we buy. Also the production, home builders, virtually, well, not virtually, every single industry somehow is related to energy. Here's a Fed funds rate in white, currently at the 5.5% level, PPI in yellow, CPI in red. Now, the CPI has that strong uptick that we saw yesterday. The PPI in yellow, again, strong uptick. Now, the Federal Reserve has stated many times they're not going to stop raising interest rates, or at least they're not going to lower interest rates until we see the inflation numbers like PPI and CPI return to the 2% level. Well, CPI is in the 3.5 area. PPI, it's lower, but again, it's still moving to the upside, and that's not good. Here in white is the core CPI. In green is the core PPI. The white and the green lines are trending lower. These are the producer and consumer prices that are not affected by energy. The red line is CPI. The yellow line is PPI, and those are the consumer and producer prices that are affected by energy. So we can see there's really just a vast difference between the two of these sectors, with and without energy. Now we see here PPI in yellow, crude oil in red, and the PPI again is affected very much by the energy sector, and we can see a very strong correlation. When producer prices go up, so does crude oil, or we could say vice versa. And either way, there's a very strong effect. And we can see now this crude oil price over here, by the way, that's registering on 80 at the moment. This reflects the reported date of the PPI, which is as of August 1st. We're halfway through September, but this is the producer prices as of August. If we were to fast forward to present day, we would see that crude oil, West Texas Intermediate crude oil, is close to $90. So it's actually even higher than what we see right now. Now, here's a very interesting chart. The white line is the S&P 500. The red line is PPI minus CPI. Now, what this is, let's say we take PPI, and that's, we know those are the wholesale prices. Now, let's say the producer out there, they buy the wholesale goods and they say, okay, well, the consumer's strong. There's a lot of demand out there. And that we're going to produce these goods and then we're going to put them on the shelf. We're going to put them on for sale, and then we're going to raise our prices to the consumer. Well, then we would see this line kind of stay flat, the red line. The red line was going down because PPI minus CPI, the producer prices were less than the consumer prices, meaning, or other way, in another way to look at it, the prices are going up. So it's actually the CPI is going up more than the PPI. Now, maybe that's, reaction or following a delayed effect from what we saw earlier. But what we're seeing now, this strong uptick, and it's not just this month. This is something that's happening actually for a couple months now, that the PPI minus CPI is going up. And it means that the producer prices are going up, but the producers are not passing it on to the consumer. They're not raising prices for the consumer. Now, do they feel bad for us? No, not at all. The producers that end up selling these goods know that the consumer can't afford higher prices, and that demand will disappear. Take a look at yesterday's video. We talked a lot about the inventories. A lot of inventories are at historic highs, wholesale inventories. Picture all of these factories full of goods. We can't sell them because the consumer just can't afford them anymore. So the wholesaler, the producer, is being put in a very difficult situation where their prices for the wholesale goods are going up, but they can't pass on their extra costs to the consumer because the consumer will just go away. We can't afford higher prices. As expensive as things are, they're actually even more expensive at the producer level. And it's not just us saying this. This is something, it was, I believe, the Boston Federal Reserve president, I believe it was from Boston. There was a couple Fed speakers recently, and one of them specifically mentioned that the producers are having a very difficult time passing on these extra costs to the consumer. Not that they don't want to, they just know that the demand is not out there. Now, this is a great segue because, in terms of consumer demand, now we see retail sales. And remember again, yesterday's report, we talk about wholesale inventories. Wholesale inventories for many different categories, alcohol, for example, distilled beverages, record highs. Automobile used parts also at record highs. That when we see high inventories, it means the producers can't get rid of the stuff. Well, retail sales reported today 0.6 versus a prior month over month of 0.5, a little bit of an uptick in retail sales. Also, on a year over year basis, a little bit of an uptick. So on the surface, well, that looks good. But now we're going to dive into the individual sectors. The blue line on the several following charts is the S&P 500, just to give us some context and a basis of comparison. The S&P 500 is a pretty good indicator of, a lot of where our stock portfolios are and our general sentiment. Well, this is the overall retail sales on a year over year basis, comparing in this case August of this year to August of last year. And we can see just slightly above the zero line, the y axis on the left hand side. And that was obviously following a tremendous surge we saw to the upside post-COVID crisis when everybody really got back to the stores. But that honeymoon is pretty much over. We're barely hanging on to positive territory. Let's jump into the individual sectors. Grocery stores, which are very much tied to inflation, barely in the positive level as well. We hit that very big low, obviously, during COVID and in the weeks and months following that. We really didn't even enjoy any great snapback like we did in the prior chart. Grocery stores just have not been doing well. We can see our electronics and appliances, always a very popular category. We had a big snapback. Seemed everybody went back to the store and bought some electronics, but that has all since gone away. And again, notice we're hovering just about zero, which is not good. We don't want to see a retail store saying we're selling about the same as we did last year. Especially considering inflation, whatever they're selling, maybe there's less of it to go around because of inflation. We see here non-retailers. I equate this to non-store retailers, I should say. This, I would say, is more online shopping, and this really does not look at all. Last month's report, we said it's hovering near the lows and then a strong tick to the downside. Kind of surprising we have our back-to-school shopping. A lot of that is non-store retailers, but that seems to be walking away from the S&P 500, which at this rate was, continuing higher. Here we have building materials and garden equipment registering new lows. These are the lowest lows we've seen going back at least to 2020, prior even to COVID. Not good news for building materials and garden equipment. Think about these different charts also in terms of your stock portfolio. Maybe we're a value player and we want to, buy some stocks that look like they're really beaten down. Well, this shows us that retail sales for the garden equipment, for example, is very, very low. But again, we would need some kind of catalyst. Why do we think this sector is going to come back? Here's gas stations. No, ticking to the upside this past month. But then again, this past month does not take into consideration the $10 a barrel in oil increase from 75 to around 85 that we've seen over the past month. It'll be interesting to see if the retail sales on gas stations turn back to the downside. This reflects a little bit of weaker gas prices and oil prices. Retail trade and food services, not great either, just a hair above 1%. And really, again, separating from the S&P 500, we'd expect to see a strong correlation. This gap looks to be wider than it's been in a while. Here we see food and beverage stores, inventories we spoke about yesterday, beer, wine, alcoholic beverages, record high inventories. Good news if you want to buy some alcohol, not good news for the retailers though. And it looks like retail sales again is barely positive on this charts. Makes sense considering inventories are so high. Motor vehicle and parts also very, very close to zero. Also, yesterday's wholesale inventories were at very significant highs. Lots of inventories that translates into very poor retail sales. Retail trade and food services. Well, it's very expensive to get out there to the restaurants these days, and this chart reflects that as well. General merchandise stores, it's about the same pattern. A lot of these are very closely linked. Also, a lot of stores, they may sell things that, bleed from into one category and another, including, electronics and then general merchandise as well. We see here is on a month over month basis. These are the actual improvements. So this month compared to last month, August to July, the biggest improvement, gasoline stations. Everything else barely an improvement on a month over month basis. On a year over year basis, we can see a little bit more of a divergence. Retail sales, grocery stores up a couple percentage points, electronic appliances down a couple percentage points. Non-store retailers year over year, again, that's probably most closely related to online shopping, 7.2%. The biggest disappointment, gasoline stations down 10%. High oil prices do not fare well. That's gasoline stations. Also, building materials and garden equipment on a year over year basis, down 4.9%. Seems to be a little bit more of a luxury item, gardening equipment, things of that nature, at least for those of us that are not directly connected to that industry. Here's all retail sales, the average with the red histogram bars. Again, the past 1, 2, 3, 4, 5, 6 months barely registering positive numbers. And if you put this in perspective, it really is not good, considering the fact, okay, we had a huge move up post-COVID crisis. That was a lot of shoppers coming back to the stores. But since then, we usually see around 10% year over year. You would think the S&P 500 averages, maybe 10, 12% a year. Wouldn't we expect retail sales also to mirror those numbers to an extent? The past 6 months, really nothing at all. And if you take a look at the whole year, the whole year going back to January, what's the average? Just a little bit above zero. Here's a federal funds target versus retail sales. Obviously, when we have a period of low interest rates, that tends to bode very well for retail sales. Low interest rates make it easier to finance lots of good things. But when interest rates go up, that hurts retail sales. And we can see now this is the overall average of all the prior charts we looked at. We're at levels here, even pre-COVID. Obviously, this big move down, that was a result of the crisis. But retail sales, even prior to that, the Federal Reserve was raising interest rates and actually cut interest rates in 2019, in part, I think, because retail sales just were not doing very well. Then we see here consumer price index. That's the measure of inflation that we spoke about yesterday. That's in blue. Retail sales average and also an inverse correlation, or I should say an inline correlation. We would expect, generally speaking, we tend to see higher retail sales during low, or I'm sorry, during rising periods, low periods of inflation, interest rates, I should say, rising inflation, because normally inflation is a sign of a strong economy. Prices are going up, salaries are going up, we can afford more, we're happier. But this inflation now is not necessarily tied to the level of productivity or GDP. That was not a good number recently, but more so, it's a produced a number of inflationary forces, M2, things of that nature. So, with that said, high inflation is not doing well, or is not boding well for retail sales. And this is again the monthly change, just to give you a little bit of a different graphical idea about where we are. The biggest improvement is gasoline stations. Following that, retail trade, food and services, food and beverages to an extent, motor vehicle parts, not so much, grocery stores, not so much, electronic appliances, these are more or less in line, but the biggest move is gasoline stations. But again, I don't know if this necessarily reflects where we are now. That was a month ago. Gas prices are up since then, but certainly, something to take into consideration. And we're going to watch these and many other numbers very closely. We still have a lot on the economic calendar this week, so we'll be sure to update you with any significant changes along the way. We hope this has been helpful. We look forward to seeing you back soon.